Hey everyone, in today's video, I'm going to be talking about 4 stocks that I'm buying here in February 2024. 3 of these 4 stocks are actually new positions for me, so this should be a fun video going through these. If you like this kind of content, be sure to give this video a big thumbs up. Helps a ton get these videos out to more people, so really appreciate that. Also, let me know in the comments what you're buying this month, but we'll just get right into it. The first stock that I added to my portfolio this month is Brookfield Infrastructure Partners. This one here trades in the US at ticker BIP, also in Canada on BIP.UN, but just a bit of a watch out. They have some very specific tax laws around this one since it's technically a partnership. So I personally actually bought this one in my registered accounts, my RRSP for the most part, just to make sure I don't really have to deal with that tax burden at the end of the year of filing this one differently and getting taxed on it differently. But let's go into the reasons why I bought this stock here. First, looking at the past 5 years, this one over a long period of time was a really great compounder. And in addition to the really high dividend that they've been paying out, they've been able to grow their share price from under $10 around 15 years ago all the way up into the 40s. Once again, these are US dollars. You can find the Canadian ticker as well if you want. I was just having a bit of a hard time finding it on Google Finance today. Then in the last few years, we've seen it crash pretty hard, as lots of utility stocks really have behind interest rates going up. They obviously have a good amount of debt given the asset profile that this company owns, which we'll get through. And then it especially crashed a few months ago. There was a short report made on the company, on just how they report their earnings and funds from operations and such, but it was mostly demythed. The stock went back up to where it was before the short report there, as the company kind of cleared up those reports as well. But I did look into it. I don't think there's too much there, honestly. So as I looked at this stock at a very high level, I think long term, it's been a pretty high quality stock, really good track record of compounding growth, pays out a 5% dividend, give or take, on the stock. And they've actually been growing the dividend. And right now I get to kind of capitalize on the opportunity that with high interest rates, the valuation and the multiples of these stocks have actually been going down. So fundamentally, operationally, they're still been performing pretty well, but I get to buy it at a lower multiple than I would have last time I looked at it a number of years ago. And we'll get into those valuations as well. In terms of what Brookfield Infrastructure owns here, on the right-hand side, you can see utilities is about 30% of their business, transportation is about 40%, midstream 25%, data centers 10%. And we'll get into what those things mean. But what's interesting is just their revenue split here. So the Americas, this is both Canada, US, and then mostly Brazil, Peru, those countries up there in Latin America contain 68% of the revenue of the company, about 20% in Europe here. You can see it's mostly Western Europe, Spain, France, Portugal, and then about 15% in Asia Pacific, primarily in Asia there, or sorry, primarily in Australia rather, there. And if we're going to look into exactly what is like highlighted in each of these segments, transportation, they own freight companies, commodity movers like railways, and also passenger utilities. That's mostly toll roads here that they say they have in Brazil, Peru, as well as India as well. So really nice assets there and types of assets that are really hard to get a hold of in the North American markets. There's not a lot of publicly traded toll road companies, and there's not a lot of access to markets like Peru, India, Brazil. So you're kind of getting the best of both worlds from a diversification standpoint in a name like this. Utilities, just like lots of the utility stocks that we have in North America, whether it's Fortis or whatnot, where they have regulated transmission and distribution of natural gas, electricity. Brookfield has their own businesses in that space. Midstream, once again, energy, transmission, storage, and whatnot. And then data, this has been a new one that they've been growing, and they'll probably continue to make acquisitions in, but they're building critical infrastructure and data storage. So lots of data centers and stuff like that from different areas of the world. You can see here they have different levels of exposure in different regions. So in the Americas, they have all these businesses. In Europe and Australia/India, down here, they have 3 out of the 4. So you can look into that a bit more if you're interested in the specifics. Their current yield, I think today was about 5%. So it's down a bit as the stock's gone up a bit since they last updated their fact sheet. And they do target 5 to 10% dividend growth every year. They actually just announced on this quarter that they're going to be increasing about 6%. So they've stayed true to that guidance as well. Looking at the growth from each of these segments, so you can see utilities here, 880 million above the 740 million from the year ago. These are total 2023 funds from operations, which is essentially operating profit for this company here. Transportation, which is one of my favorite elements of this company, just because it has toll roads, it has exposure to these other markets, really great diversification for me, grew about 10% above 2022. Midstream actually went down from 750 to 700 million, give or take, but that's primarily because they actually sold a U.S. midstream asset partway through the year. As you'll come to see with Brookfield, they're actually great capital recyclers. They'll buy assets at what they think is lower discounted EBITDA multiples. They'll build up these assets, accelerate the growth, take out lots of the cash flow, but then ultimately they'll try to sell it at a premium, reinvest those dollars in other areas that they think may be underdeveloped or undervalued. And that's literally what they're doing right now with data centers. So as they've been selling out midstream assets, they've been buying some freight companies to add into their transportation business, and also buying some data centers to build up this data business to be a bit of a bigger element of their overall mix there. And then lastly, you can see, even though the unit price really hasn't been trending well over the last few years as people are comparing the interest rates and whatnot, the overall underpinning fundamental operational performance of the company has been pretty good. 10% growth, 13% growth on funds from operation per unit. Their annualized run rate is about $3 US a share, so close to $4 Canadian a share, which actually gets them trading right now around 11 to 12 times earnings if you buy the partnership shares, which are currently about 42 bucks Canadian here. So on this one, really like the infrastructure play. I don't have a ton of infrastructure aside from the utility stocks in Canada I do have in my portfolio, but I liked how I'm also getting some geographical exposure. I've been talking about that a lot this year, and I like those toll roads and some of their other businesses that they have, and long-term their operational track record, even though the stock hasn't done great in the recent few years. I think the underpinning of the business is really strong. So excited to hold that one, like the 5% yield, like the growth rate on the yield. This is one that I'll continue to follow along quarter after quarter with the earnings, but maybe one I add more to in the coming months and weeks as well. The second stock here that I added to my portfolio is actually an ETF. It is the S&P Healthcare ETF. Looking at this one in the last year, it's up about 8% here. And this ETF is actually trading right around an all-time high. But I really wanted to get a stock that had a lot of healthcare exposure. I looked at lots of the pharma companies. I looked at some device companies like Medtronic and whatnot. And ultimately, I decided to go with an ETF here. Looking at just some of the breakdowns of this ETF, it's about 30% pharma companies like Eli Lilly and whatnot. We'll go through the top holdings in a minute. 20% healthcare equipment and supplies, 20% providers and services, that's like UNH and whatnot. Biotechnology, 15%, and 11% life sciences. So I feel pretty good building this up and having just this ETF holding all of these healthcare companies within the S&P 500 as my overall healthcare position here. In terms of the top stocks that are in, you can see Eli Lilly, just huge pharma company in the US, at about 11%, United Health Group, a big insurer, 9%, J&J, Merck, AbbVie, Abbott, Amgen, Pfizer, etc. So you got some companies that kind of are more copycat drugs companies like AbbVie and whatnot, or biosimilar companies. And then you got some of the ones that invest a ton in R&D and really go for those groundbreaking patents that can drive a lot of accelerated growth down the road for those companies if they hit big on one, like Eli Lilly, and they've been hitting big on a couple of theirs as of late. Looking at a bit more on this company here, their management fee, and one of the things that makes me feel comfortable investing a pretty big amount in this company here, is actually about 9 basis points. Let me just get to that in this sheet. So the management fee up here, gross expense ratio, so under 0.1% every year. That's definitely something I can live with. and their dividend yield, if you saw it, is about a 1.6%. So you do get a nice tiny yield on it as well, which I like to see. But ultimately, this one's about exposure. One of the cons about this one is it's not a global ETF on healthcare providers. So it's lots of great pharma companies in the UK. I think Novo Nordisk, think GSK, etc., that are not included in here because this is literally just the top healthcare companies from the S&P 500, I believe, is how this fund is orchestrated. So you miss out on some of those, but overall, I think a really high quality fund, a really low management fee on it, and it's just overall in a space that I think as the globe ages will benefit greatly, and lots of really cool innovation being worked on in this sector that I don't want to miss out on just because I don't understand the space well enough to own some of the individual stocks in pharma as an example. Going to the third stock, this one's also an ETF and still on the theme of diversification and globalization from a geographical perspective. This one is the Vanguard Emerging Market ETF. Looking at this one in the last year, it's actually flat, which I didn't mind. I thought, hey, maybe I'm getting in at a good price here. Pays a dividend yield of about 3.6%. And if you were just going to look at what geographical diversification do you really get from this ETF here, it is a lot of emerging markets, obviously, given the title and the purpose of the ETF here. But it's worth noting that not every investment I have in my portfolio is necessarily to maximize the growth in my portfolio. I bet you over the next 20 years, I feel with pretty good confidence, this ETF versus an S&P 500 ETF, I'll probably outperform in a great way with the S&P 500 ETF. But it's all about just managing my overall portfolio, my diversification. Like 3/4 of my net worth is in S&P 500 companies, as well as big Canadian stocks. So I don't mind having a couple percent here and there, maybe globalizing my portfolio, getting some exposure to China. It's about 30% of this fund. India's 21%, Taiwan's 19%. Then you get some exposure to Brazil, 7%, Saudi, 5%, so on and so forth down here, where it would be really hard for me to naturally get exposure with North American stocks. Thailand, 2.5%, UAE, Qatar, Turkey, etc., as it goes down there. So it's just good to know and makes me sleep better at night knowing my portfolio is really well diversified geographically, and I do kind of have lots of these countries, especially the big ones here like China, India, Brazil, crossed off with a decent chunk, at least in one position. So I get that a lot when I buy kind of international stocks, international ETFs to diversify, that I should just buy the S&P. I totally get where people are coming from, but I just look at it as like, hey, with 1% or 2% of my overall portfolio, it's just good to be diversified, even if it does lag to some extent. So we just went over the total allocations as a percentage by country. Just looking at some of the stocks that you guys are probably familiar that are in these baskets. You got the big Taiwan and Chinese companies like Taiwan Semiconductor, Tencent Holdings, Alibaba, lots of banking, some real estate companies there as well. So some of these, or lots of these, especially on the top, you've probably heard of, and then it probably drops off a bit. In terms of the sector, 23% technology, 12% consumer discretionary, 9% industrials, 20% financials. So a pretty decent mix here as you go down the line into consumer staples, healthcare, telecom, etc. as well. So I just like this overall ETF that's capturing some of these markets for me, and I just don't really have to worry about getting exposure in other ways. I just pour money into the stock here. And the other good thing I like about VWO, it pays me about a 3.6% dividend yield. So that's good to get a bit of dividend income every quarter to reinvest either back into this ETF or maybe some other ETFs or stocks that I own separately. And then the last stock that I am looking to buy more of this month, this is one that I have been buying throughout the last few years as it's kind of stalled, as you can see here on the past 5-year chart. And one of my biggest positions overall across my accounts. You can see here it's currently yielding about 5.1%, pretty big market cap here. The second biggest bank in Canada behind RBC, but I really love TD Bank, and on these little drops that it's been having, especially here in the last month, down to 2.5%. In the last 6 months, computer's freezing up a bit, but in the last 6 months, it's really traded sideways as well. I think it's a good opportunity to add more. And I really do think they're going to continue to grow their dividend. They have pretty diversified exposure in terms of where they play. And you're kind of getting a sense of that on the screen here. I'm going to go through these slides quick because I've talked about the stock before, but really well diversified in the northeast side, going down the East Coast in the US, and then all over Canada with their branch network. And then also from their revenue mix, unlike some of the other banks, they don't have a huge capital markets division. So I feel like they're a lot less volatile of a bank. 30% from retail banking in the US, 50% from retail banking in Canada, and then 6% just from their equity investment in Charles Schwab, which leaves about 20% for wealth management, insurance, etc. But you're not seeing bundles or baskets of revenue or earnings mix that sways to an extremely great extent like capital markets might for some banks in the US or for RBC as an example. And they've really stayed true despite, some of the challenges over the last few years for the broader banking sector to continue to increase their dividend, continue to drive earnings per share. And that's really great to see. So you can see here, they now pay out almost $4 a share. I think I first bought into this stock when it was probably close to half that, and that was not even 10 years ago. And they've already doubled their dividend payout pretty much on top of the capital appreciation they've provided overall. They're paying a 5.1% dividend today without exceeding 50% of their earnings going to the dividend. So they're still keeping 5% free cash flow yield within the company pretty much to reinvest either share buybacks, other growth opportunities, driving more digital aspects of the business, M&A, whatever it may be. I think they're in a really good position here at under 10 times earnings. Looking at their estimate for 2025 here, which is the fiscal year they're going into, 845. So they're trading just under 10 times earnings, about 9.5 times. I don't mind TD here under 10 times earnings. I'll take the 5.1% dividend. It's going to likely grow every year. And I'll, wait for the cycle to turn back into favorable territory for these banks, for their earnings to accelerate, as well as hopefully their multiple to correct a bit, at least to the low teens. So this is one I'm not diving into in a huge way because I already have a pretty big position, but it's one that I'm going to continue to nibble on throughout the month. So trying to get through those 4 quickly. Thanks for watching this video. Let me know out of these 4 stocks which ones you're interested in or if you own any of them, and I'll see you guys in the next one.